Now, for more on the lessons learned from the financial crisis, we are joined by Bart Naylor, the former Chief of Investigations on the U.S. Senate Banking Committee, who is now a financial policy advocate at Public Citizen, and Jack Burkman, a Republican strategist, who is the founder and president of Burkman Associates, and our own Phillip Yin in D.C. Bart, let's start with you. Hank Paulson, who is the former head of the Treasury Secretary. He was also known as the mastermind of the bailouts. Now, he said it's inevitable that we will have another crisis, but that Dodd-Frank has given us the tools to deal with it. Do you agree with that?
All right, let me help you out here. Karina's asking you if the Dodd-Frank deal made it more difficult for the current regulatory environment that we have now, or is it more of a solution for that?
Dodd-Frank is a solution. It restates the powers that regulators had even before the crash, and it sort of says in bold capital letters, please stop reckless banking. The problem is, of course, Wall Street has a political grip on this town. If you make a lot of money and you're smart, you figure out you should buy politicians to keep the game alive. And they have stymied the implementation of Dodd-Frank so that of the 400 rules from Dodd-Frank, about a third of them have been implemented. And then, of course, they buy the regulators as well.
Well, yeah, the whole thing is just amazing, Karina.
Let me offer you this. There was no crisis. The crisis was manufactured by politicians looking for to help their political fortunes. Look, a bunch of investment banks gambled. They should have been allowed to go broke. None of it, the government didn't need to waste $1 trillion with all this. These banks went to Vegas, they gambled, they go broke. That's what a capitalist system is. And the president said, well, there wouldn't have been loans to small business. He's right, because too many loans to too many people were the whole problem in the first place. That's just the way a market economy works. Do you need Dodd-Frank? Oh, my goodness, no, you don't need anything like that. The only problem was that the federal government, and Bush did this, I faulted Bush at the time, both Bush and then Obama did it even more. They're to blame, both of them, because they put the taxpayer dollars at risk. Had I been president, the only thing I would have considered, I might have considered doing 5% of that to both B of A and Citibank, because there was some talk they might collapse, and the government was on the hook for the depositors anyway. That law is already enforced since the Depression. I might have done that. Bailing out Goldman Sachs, I mean, Hank Paulson just functioned as a racketeer, for God's sakes. It was a low moment for the U.S. government.
But Jack, I mean, we saw at the time just how quickly the markets were reacting to everything that was happening. We saw how interconnected everything was. The banks were not lending to each other. This was, as Hank Paulson said, this was not about bailing out Wall Street. It was about helping Main Street. I mean, you do not believe, you think that basically you should not have bailed out at all?
Oh, no, nothing. Of course not. The banks not lending to each other, that needed to happen. All of these things, too many loans to too many people, that was the whole problem in the first place. The first thing the government should have done is said, look, the market economy wants to punish these actors. These banks need to go out of business. And you say markets plunge. So what if the Dow plunges? Is the government betting long instead of short? If people are worried about their 401k, for God's sakes, they can sell short just as easily as they can sell long. I mean, the government shouldn't stand for the proposition that somehow it's patriotic for the market to be long. I mean, what's the difference between a 6,000 Dow and a 17,000 Dow?
Hey, Jack, Phil here in Washington. Good to see you, by the way. There's a little law called Glass-Steagall that basically they had the investment banks, which were the gambling banks and the safe banks, and they basically allowed the repeal of that act, allowed them to basically combine themselves to cause what we know today as this too big to fail. Can we reverse that? Do you think the banks should just be separated altogether?
Well, there's a need for some oversight. I actually am a former banking committee staffer myself on the House side, my distinguished colleagues on the Senate side. I was involved in Graham-Leach-Bliley. I mean, I think there was a need to repeal Glass-Steagall. I really don't think that's the problem. Giving banks these new rights and privileges, the banks can do what they want. These are fundamentally private and not public institutions. If they choose to gamble, that cannot become somehow
let me get Bart into that. I mean, he's basically saying too big. It's okay to be too big, basically.
Well, no, I don't think it's okay to be too big. But these are not private institutions. We have socialized two things in America.
But see, that's wrong. That's wrong.
We've socialized health care for people over 65, and we have socialized the source of money for banks. So, no, we had a contract. We have a contract with banks saying that we're going to guarantee your sources of funding. We're going to make it cheap, and we're going to tell all your investors that you don't care. You don't need to care if the bank is well run or well managed. But in return for that guarantee, we tell those banks, you need to do socially useful things. You need to make patient loans, and you cannot gamble with those socialized deposits. And so I'm sorry, this was a major mistake, Mr. Burkman, to repeal.
Oh, my heavens.
Yeah.
Listen, I don't know what he's talking about, some kind of social contract with the banks. The only law I know of, and it's a good law, was passed by FDR during the Depression, which says we guarantee the depositor's money in the bank. There's no rule or law or federal statute that says banks have to make loans to people they don't want to lend to.
Yes, they have to make commercial loans, they have to make home loans, and they cannot gamble. They cannot say, you know, we've got this free money for 0%. Let's go to Las Vegas. That's what the other part of the 1933 National Banking Act, sometimes known as Glass-Steagall, said, and it served us so well until 1999, when apparently you advised your principal to repeal that and say, go ahead and gamble, because these financial innovations somehow, although we built the pharmaceutical industry and the automobile industry and the railroad industry, somehow we need to have swaps because the banks just are so smart.
But my friend, capitalism is dynamic. Capitalism is dynamic. It's not static.
Oh,
it's
you say
a good
dynamic.
thing for those banks to fail.
I call it nitroglycerin. That's not dynamic. That is called gambling.
No, that's good though. You see, but you don't understand.
But what is good about it? What good has happened? What good has happened since 2000?
Well,
name one positive thing that banks did. The ATM machine.
Here, I'll tell you. There would have been many positive things, save for the fact that the federal government intervened and saved bad actors. Had the federal government not intervened and saved those bad actors, the capitalist system, once those bad actors went broke, capital would reform, and you would have better, nimbler managers of risk.
So you admit things were bad from 2000 to 2008, and then somehow because we saved them, it's been worse?
No, it was nothing worked bad.
Let me step in, guys. Both Bart and Jack. I mean, we've had both of you guys on air a number of times. I asked both of you the same question, okay? Jack, let's start with you. What needs to be done from this point going forward? Forget about the past for just one moment, but in the next year and a half, as they think about ways to regulate ourselves to not have another crisis, what's the number one thing that should be done?
Well, Dodd-Frank is a disaster. It's slowing down New York as a global financial center. Every day I talk to a businessman that's being hampered by it. It's got to be repealed. That can't happen until there's a Republican president. 99% of it simply has to go.
Bart?
Well, I'm not sure what businessmen, if you're talking to, if you were saying we're hampering the gambling profits in New York, I'm not sure where you live, but I doubt it's Des Moines or Boise, Idaho or Yakima, Washington. I bet it's Wall Street, and I bet they are feeling slightly retarded in their business. Fine. Wall Street should not be 8% of the economy as it was once 4%. Three things. I'm sorry, there's not one thing. We need to cut down the size of the banks, we need to restrict their gambling activities, and we need to put equity at stake. Banks put 4% of their own equity. It needs to be closer to 20%. We ask a home borrower to put in 20%. We should ask a bank to put 20%.
All right, we're going to have to end it there, you guys. Bart, Jack, I'm saying this carefully. Always a pleasure to have you guys on the show. And of course,
pleasure is ours.
With us in New York City, being a good sport and staying out of the trouble here. Karina Huber, thank you very much. We're going to see you in just a short bit.